Things dropped pretty fast today, so I'm going to break down today's decline and see how that compares to a very similar decline that we had last week that sets up a potential reversal price pattern. So I'm going to break that down, also break down other technical indicators to see whether or not they support this bearish move that could lead to more bearishness, or the we can expect a bounce off of the lows next week like we've seen in the recent past. So I'm going to break all that down from a technical perspective, as well as what's leading this decline and how to take advantage of it if it persists with our trade idea of the day. So let's go ahead and get started. Today is Friday, April the 6th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching us for the first time. Glad you found us. Keep watching day by day. Subscribe to our YouTube channel. You can click that red subscribe button that's right down below this video. You can do that right now while you're watching. Also, while you're down there, click that thumbs up icon. That lets me know that you like the video. And it also tells me with one click to do the video again, right? To keep doing the videos Monday and Tuesday and Wednesday and next, and just keep on doing these. The way that we know if you like these videos and you want us to keep doing them, that's it. We don't have a survey we send to you. We don't have an email. That we send. We look for those clicks, and the more we see, then the more we know that you want us to keep on doing these. Also remember to comment on anything that stands out to you from today's video. You have to scroll down further to see the comment section down there. Also join our daily Market Outlook email list. There's a link in the description down below to join that list. Follow me on Twitter for more content like this throughout the day, throughout the week. You see my handle at the top, @DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Finally, join our Market Outlook community on Facebook. Again, the address is at the top. There's also a link that will take you there down in the event description down below. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And you can see the pullback that we had brought the near-term line back down out of the upper reversal zone. So you kind of got that bullish pattern where the near-term line kind of entrenched itself in this overbought area, which is actually a good sign for a bullish trend reversal. As you can see here, we went from bearish to bullish with the near-term line getting up there. But again, remember how weak our bullish posture was, and just like that, it turned back to bearish. So, the bulls fumbled the ball, and the bears picked it up, and they've got it now just a few yards away from their end, from the end zone. So that's why I say that, that bullish posture is about as weak as it can possibly be at those levels before things turn around. The momentum line dipped. Did not dip to an extreme, because you notice we did come off the high at the end of the day. So again, relatively long lower shadow compared to some of these lower shadows we're getting here. You notice we're not closing at the lows day in and day out. We come up off those lows, except for these 2 days right here where we did close pretty much on the lows. These other big down days, we come off of them. So not quite able to maintain the bearishness. Excuse me. So market sentiment's falling. That makes the path of least resistance to the downside. You see all the red candles. That's what happens when you have the long-term market sentiment line dropping like that. Intermediate line turned down, bearish again. Not as strong because it's not in the reversal zone yet. And remember, it doesn't really stay in the reversal zone for too long. And remember also too that near-term line still hasn't dropped below 50. Right? So it's we have a pullback here, and again, for those who follow me on Twitter, if you recall, I tweeted that out yesterday, the potential for that, for a right-handed shoulder, so an inverted head and shoulders, right, with the right shoulder developing now that we've touched that level. I followed that up today. I changed that line a little bit. So instead of coming from that peak here down to this low point, from the immediate low point, I changed it down to the low point that I got by the end of the day. And you can kind of see that we followed that path. I mean, this is a duplicate line of that one there. And we followed that path, and that was before the end of the day. And you also notice, too, this red line right here. That red line is coming from this downward slope, right? So if I were to take a look at SPY, it's coming from that downward slope right there. So that was our resistance coming across all these high points. We had broken up above that on Wednesday, pulling back down, and you can see on an intraday basis holding some support around here. And you see that other line this other line here is where the bottom end of that left shoulder is, which happens to be last week's low point. So you can kind of see why we kind of fell and found some support in this area. Now we can break that support because anything can happen. Excuse me, but you can see there's multiple areas of support, and we followed a move. Even with this negative news that's out there, we followed a move very similar to what we got last week in producing what could potentially be an inverted head and shoulders pattern, reversal pattern. Of course, you can see, it would be, on an intraday basis, reversing this downward slope that we've had, that near-term line that was down, that near-term run that brought the near-term line down for like 13 days there. Sharp move. So we're trying to start a new trend. We got the path of least resistance to the downside. It's not going to be easy. And you can see right now we've pulled back today on the tariff news. But not, interestingly enough, the pullback was not strong enough to change, to break that support. And not strong enough to break down through these levels, which, again, all those short-term layers of support. But you also have the 62 Fibonacci retracement area, which has been touched now twice on that bullish run, that 5-month bullish intermediate run that we had, plus the 38% Fibonacci retracement of this long-term run that we've had from November. So there's a lot of support in this area. Even when you start to look at like volume profile and you start to see, okay, here is SPY. You can start to see there's a lot of volume in SPY in this zone right here. There's a lot of it up here too, and that's why we couldn't quite get above it. There's a lot of volume in this area. We hit the resistance, we came down right off of that, but there's a lot of volume in this level. There wasn't as much here, and we fell right through, and there's a lot of volume now here. Now, if we break this level, it's going to be pretty much a good free fall down until we get to about 260, 247. That's about 10 points away, because that's where the next area of support is based on the volume that traded hands over here. So that's the downside that we have. That's the potential downside that we have to work with. So this volume profile is another technical indicator that kind of shows at what prices, not so much on a time basis, but on a price basis where all the volume is. Because this volume shows you how much volume is traded on the time basis. This chart shows you all the volume that's traded at a price, on a price basis. You can see there's a lot already that traded hands up here, and we met some resistance. And now on the pullback, there's some down here from, again, lots of volume at these strong lows that we had these 2 days. A lot of buyers came in to keep these lows, to hold these at this area. So to overwhelm all the buyers that are sitting in this area, you'd have to get a good breakout. And if you do, again, the next range of buyers will most likely come in here, where there's been some buyers and sellers trading hands before in the past. Quickly go through all the other major indexes here really quick. On the Dow Jones Industrial Average, you can see very similar near-term, momentum line dropped down, near-term line pulled back. We did not go down to new lower lows. Intermediate line turning down. Market sentiment below 50 is almost the exact same pattern as what you see on the S&P 500. The NASDAQ also did not come down to new lows. Did not get below that, that really strong morning star-ish candlestick pattern there. It still has a strong bearish posture. Remember, it's a little bit more bearish in the short on this intermediate run, but the long term was so outperforming that the market sentiment's not below 50 yet on that. Bearish posture, and a renewed bearish posture on the Russell 2000. You notice its near-term line is more bullish. It was more bullish on this bounce. It hit that resistance of this trend line coming down and wasn't quite able yet to break up through, and so we pulled back, and we pulled back more on a more volatile basis, because remember, the VIX is already, remember the VIX didn't drop below 20 at these levels. As you'll see here in the VIX, with this pullback, the VIX didn't really bounce back up much either, especially not up to these levels that we saw over here. Okay, before we look at the other charts, again, a quick reminder that if you're watching this video embedded in our blog on marketscholars.com, you can see, there's your video there. Remember, you can also click on this icon here to see the video in full screen. We've been getting questions about this. You can click that icon right there to see the video in full screen. You can also use the settings here, this gear, to change the speed if you want to watch this in 1.5 times speed or 2 times speed, if you can handle that. You can also change the resolution. Set it automatic based on your internet quality that you have currently, because it changes, right? No matter what you have subscribed to, it will be based on that. You can get all the way up to 1080p on there. That's how but it will put it at the best quality for you. And then, of course, you can click this YouTube logo and watch the video actually on YouTube, where you can click that subscribe button to the YouTube channel, click the thumbs up icon, comment, all that jazz there. You remember, while you're watching the video, you can hit the heart and like the video on Twitter. You can also hit this thumbs up on Facebook if you have a Facebook account there. Doing those 2 things tells me you want me to keep doing these videos with a couple easy clicks. It also tells Twitter and Facebook that this is engaging content. So it's almost like you are Twitter and Facebook. You're telling them you're recommending this content for others, and you're doing it in a really, really easy way, even if you don't have any followers, because what they will do is they will see all this engagement and they'll say, oh, this is really good stuff. We're going to make sure everybody who follows David sees this, because that's not always the case. Not everybody who follows me sees all my stuff because of the algorithms that Twitter and Facebook have. So the more you click on that, the more it helps me get the word out about the Market Outlook video. Remember, you can subscribe to the email list right here if you haven't done that already, to get our daily email, Market Outlook email. Also, too, I wanted to talk about a quick little promotion that we have going on. If you notice right above the video, there's a link to discuss anything in today's video in the Market Outlook forum. When you click on that link, it takes you to this page right here, where you can create new topics, which automatically down here in the bottom, you can create a new topic. You just give it a title and put in your topic there. You can put images in. You just have to make sure you host the images somewhere. A lot of different coding there, HTML codes. And then just click on submit. That will submit a new topic, or you can just click on any existing topic here and reply to it. So, for an example, if you were to come here to this one on top, that was just posted 5 hours ago, you can click on that and then reply to the post and hit submit down here at the bottom. So now, here's the fun part. Now, if you don't get that through the blog, get there through the blog here with this link. You can always just come up to the top, go to forum, mouse over forums. Don't click on it yet, but mouse over forums and click on Market Outlook. For subscribers, for Market Scholar subscribers, you can see we have forums for all of our classes, and that's where you can get to those there. And if you click on forums here, it will take you to all of our forums that we're currently building out for different various topics here. All right, now we have a promotion that we're going to do, that we want to do from today, April the 6th, through May the 5th. Right, and the promotion is, here we go, give me 1 second here. The promotion is, we will give out a $100 Amazon gift card for the subscriber, for the person on our website who engages the most in the forums. Now, what is engagement? The engagement is new topics and replies to existing topics. All of it counts. So every single time you do anything in the forums, we add all that up, and the person with the most engagement from now, April the 6th, through May the 5th, which is a Saturday, so by the end of that Saturday, then you will get a $100 Amazon gift card from Market Scholar. So thank you for the engagement in the forums. For the person who misses out and gets second, we will give you a $50 Amazon gift card for just barely missing out there. So 2 gift cards for the people who engage the most. And again, new topics in any forum, Market Outlook, classes, whatever, in any forum, any new topics, and any replies. It all gets added up to see who gets the most engagement. And then finally, we will do 3 random drawings for $50 gift cards as well. So, in other words, if you didn't miss, if you're in those 2, if you weren't those top 2, you still have a chance to get a $50 gift card. And the way you get that is your name will be put into the hat, so to speak. And every time you do something, a new topic, you create a new topic, or you apply to an existing one, every time you do something on the forums, your name gets put into the hat. So the more you do, the more your name gets put in, the more you engage, the higher the odds that your name will be pulled back out and drawn randomly for one of these three $50 Amazon gift cards. So that's our promotion from starting today, April the 6th, through May the 5th. So again, $100 Amazon gift card for the person who engages the most when we add up all the topics you create, as well as all the replies you do to your own topic, to your topics if you're replying to somebody else, or to replies to anybody else's topics. So we add it all up. So $100 for the most, $50 for the second most, and then three $50 random drawings. So 5 winners total, 3 random drawings, and again, your name will be put in the hat every time you do something on the forums. So again, just a reminder to get back to the forums. It's right here. You just click, you mouse over forums. You can get to all of our classes if you're a paid subscriber. You can also get to the Market Outlook forums. Anybody who watches these videos can go to the Market Outlook forums and be able to get to there. Remember, it's also posted in the blog. Whoops. It's also posted in the blog. Really easy for you to find. It's right above this embedded video right there. That will take you there. And you might have to subscribe to be able to do that, but you don't have to be a paid subscriber to participate in the Market Outlook forum. You do have to be a paid subscriber to participate in the classes there. And of course, if you have any questions on that, on the paid subscriptions, there's a link down here, right above this green like button, that will give you some information on that. So now let's get back to the charts and see the long-term view. And again, you can see we're fiddling around as the gap between the 50 and the 200-day moving averages declines. And it's declining pretty rapidly. But remember, even at these levels, it's still pretty high relative to where it's been in the past on an absolute basis. We're really dropping down, again, forming another long lower shadow around that 200-day moving average, kind of sitting right on that 200-day moving average, which is now flattening out after being there around for 3 consecutive weeks, getting up to the 50-day moving average and not quite being able to get up above it. That's still positive momentum, just rapidly declining long-term positive momentum. But, you know, again, we're not busting through that 200-day moving average yet, which usually occurs as we get closer. And usually we grind our way to with a lot of volatility. We are getting a lot of volatility with arrows, so that's why I wouldn't be surprised if next week we get a green arrow. We get back above that 50-day moving average. Whether it goes up to new highs or not on this current run, who knows? But I wouldn't be surprised if we bounce off of this and get that green arrow again here next week after, you know, 3 weeks now being below the 50-day moving average. Looking at the 3 green arrow chart, you can see we did get 2 green arrows here. The MACD did get up above its moving average, and so did stochastics. They both pulled back, but they're still up above their moving averages. Yes, we pulled back down below that 8-day moving average, but not as deep this time as the last time when we pulled below the 50-day moving average. And remember, you get above the 8, you still kind of test the 17, and once you get above the 17 and we stick there, then we pretty rapidly get up above the 30 because, you know, that MACD moves pretty sharply to the upside. It doesn't grind its way up like it grinds its way down more often than not. There's the intraday chart with that orange dotted line. Again, a copy of this one here from that peak there, and there's actually more right there. It got drawn on the hourly chart, on the 20-day chart, so that's why it looks a little bit different. But that's what it looks like. That's the copy of it here. And so you can see it's, you know, that we followed that move to the downside. Similar move that we had there. Wasn't as fast, actually, as what we saw on the 27th. But you see how the 28th, we held there and bounced off. And eventually went up, you know, came down, formed a head. This head pattern here, we bounced off and now formed the right shoulder. And came back, or formed, you know, got back to the neckline here at 266.5. Pulled back down to 259 again, similar to that move there. And you can see there's that downward sloping resistance line that we're holding. There's last week's low point that we're holding. Of course, we talked about the Fibonacci areas that are also holding. Here, let me get rid of these lines here really quick. This is yesterday's lines here, and this one needs to be moved down to the low point yesterday. So that's yesterday's high and low point. And of course, today's was so extreme on a range basis. Really wasn't extreme on any other basis. So here, give me 1 second here, and we'll get those lines. And you can see the low did dip below last week's low point, but we held last week's low for a support level to the downside. So we pretty much traded this week with a little bit of a dip there early on Monday. But after forming that low point on Monday, we got right back above and traded within last week's range again, and pretty much kept within that range by the end of the week. There's all the volume picking up there at the end. If you take a look at the volume here, again, 1.5 times the average. There's our other 1.5 times the average, and you see that what happened afterwards both times. We bounced right off of that. Doesn't mean it has to happen again. But you can see, we're getting this is stronger volume to the downside. 180 million. If you look at the trading range at 7 points, you put that in the context here. 7 points is extreme. 170 some odd million, 180 million is up above this high, so that's pretty extreme too. And when you get such extremes, that's it's hard to maintain the bearishness with such extremes there in volume and a trading range. And just a quick reminder too, as volatile as we are right now, taking a look at, for example, this volatility range here. Let's say we were, the ATR was what, 3.65 points here, and we were trading at about. We eventually got down to, what was that, 175? So 365 divided by 175. So the ATR was 2% of the price at that point, at this point here. And you can see where the volume was, much higher than it is right now. In fact, that's about where today's volume got to. That's where the average was back then, the last time we were this volatile. And of course, right now, the volatility, 5.13, the current level, divided by the current price at 260. And you can see we are just about as volatile now on a relative basis. See, it's higher on the absolute basis, so it looks worse, but in reality, it's not. It's on a relative basis, we are still not quite as volatile as we were in early 2016 that launched that move there. And things are pretty sour and pretty dire in early 2016. And again, that was before the election cycle that really started this move right here. That all the fiscal expectations and hopes and dreams that came out of that election, that presidential election, that fueled a lot of this run, similar to how 2013, 2014 was fueled by fiscal hopes and dreams and expectations, or excuse me, monetary, the QE and how that can help things out. So similar moves, just fiscal versus monetary, but the reality is, they were juiced, the markets were juiced. In this case, reduced for quite a bit, just like it was here. We got some volatility coming out of that, and we get some volatility here coming out of it before setting up. There's not a whole lot of juice here, but the market still rallied off of that low point despite that. And again, here's another reason why Monday, Tuesday, or next week, we can bounce back up off that 200-day moving average and head back up potentially above the 50 is, with this dip that we had at the end of the week, we didn't even get the VIX up to as high a level as we had at the beginning of the week. So just a reminder of where we were at the beginning of the week here, right here. Go back to the 10-day chart. So the VIX was only about 21.5-ish compared to 25. So here's the beginning of the week, and here's where we are right now. And then you look at, kind of this drop compared to where we were last week, and go back to the VIX here. And you can see the week before, when we were hitting this low point about now, so the left shoulder of the Head and Shoulders, the VIX got up to almost 25, got up to 24.94 at the highest point, getting up to 22.5 at the highest point here before settling at 21.5 off the low. So, the potential for a lower high after coming off a slightly lower low point, volatility is starting to trend, still in the 20s. That's why we're so dang volatile. That's why the moves are bigger and the volume's a little bit bigger. But the reality is this is not nearly as extreme of a move right now that we got originally in early February. And the market's not nearly as scared heading into the weekend as you would think it would be with how big of a drop that we had today. And of course, that's on an absolute basis. If you go to the relative basis here, again, it's bearish. Volatility is bearish. It's at 1. That's the bearish mark. 90-95 is neutral. 1 is kind of that sweet spot for the bearishness. And we've been there at that sweet spot for a while now. but it's not extreme either. It's not, we're not getting above 110 where, things are going crazy right now, and we're still kind of grinding our way slowly back down to the lower end from 110 down to 1 or below. And you can even see on an intraday basis there. Once you get back through the neutral zone, 90 to 95 on the downside, then that's when things will be more bullish again. So again, another sign that things are not as bad as really they could be. Now, of course, that all changes. News can impact technical analysis. That can throw all this out the window. But just based on how the market's set up, you remember that all changes if we break through this level right here. Remember how all that volume's right here. Where was it on this chart here? We break through this level at 258-ish. And then our next stop, where we're going to get some support, is going to be at 247 to 243.5. In this area here, where you have a couple of big spikes of volatility, which happens to be the top end and the low end of this range. That's where our next layer of support is going to be, and that's quite a ways down. So that's where we'll find the next layer of support and some decent buying opportunity. But in the meantime, you expect this support to hold until it doesn't, and if it doesn't, that's where the next layer will be. All right, now we transition to what drove the price action today. Of course, the big news is the China reaction to the tariffs and how that sparked things. Things really kind of started to precipitate to the downside when the Fed chairman talked about, in fact, I even think it says it on here too, they talked about how those tariff talks were in early stages. So that kind of was not necessarily the best thing for the markets to hear. And the fact that he was actually relatively hawkish in saying that economic risks are balanced, but growth is picking up and price inflation has potential of picking up here over the next few months. But of course, and remember again, the economic indicators are still relatively positive. I mentioned today the employment number on a headline basis was so low down here, but we forget how bullish the last one was. It was the highest one that we had in a couple of years, and the highest one really, because it got revised above that level in June of 2016, it's the highest level we've had since October of 2015. So it's been almost 3 years since we've had that strong of a figure last month. And so, it averages out here. And, when you average those out, these two bars end up being right about this area and right about in this area right here. So not that bearish when you put it from that perspective. In fact, if you look at the year-over-year growth rate, it's the highest it's been since we dropped, since that September produced that low point right there. That low point we've been bouncing off of ever since and growing off a year-over-year basis. So, big grain of salt in today's news, and this kind of also shows just how bullish our economic growth potential is relative to overseas, right? To our peers and our quote unquote competitors and the G10, other major economies where things are not looking nearly as bullish. So of course, GDP estimates pulled back a little bit yesterday, but remember, just under 2.3%, that's still a relatively high figure from a seasonal standpoint for this particular quarter, which has been negative in the recent past and barely positive in a couple of other quarters. So keep that in mind when you're looking at what this number ends up being. And of course, everybody's talking about rate hikes, but remember that the Fed is expected to raise rates in the next meeting in June. The question really is, are we going to get three or are we going to get 3 for 2018 or 4? We've already got 1. So and here's what happened to the odds of that 4th one in December. These two columns here, you can see there's the 4th one in 2018 dropped down considerably. So the odds with this tariff news and the drop in the stock market and the volatility we're seeing, the odds really dropped pretty sharply for a rate hike. I mean, the Fed kind of looks past this headline number here, and he even mentioned that today in his remarks, the Fed chair did. It looks past the headline number and instead looks at that participation rate, which is still relatively low comparatively speaking, And of course, looking at the year-over-year average hourly earnings, which jumped up for on a total basis, but when you take a look at the non-supervisory, the production and non-supervisory roles, it actually stayed pretty stagnant. So most of that growth is in the supervisory type positions. So not quite the really big move higher in quote unquote wage inflation that you see in the headlines. So don't read a lot in the headline figures and just recognize that the economy is still, and everything's relative, the economy is still doing relatively well compared to other major economies that are out there. Here's the impact that it's having on the different asset classes. So of course, after peaking yesterday and pulling back, and that news kind of came out last night overnight, the response, then you can see the Chinese response. You can see U.S. stocks, large cap stocks falling the most since that peak. And you can also see crude oil and emerging markets. So that's China there, Chinese stocks, all falling the most on that. And there's your safe haven asset classes. And again, you look at the high yield, so not investment grade, but high yield bonds not dropping very much on that pullback off that high point. In fact, you can kind of see for the week that was. So here's the week that was, right? The week that got us back to the 200-day moving average, dropping S&P dropping 1.5%, emerging markets getting hit the worst, crude oil down almost 5%. But then look at high yield was flat. High yield was flat, didn't drop at all. So kind of goes to show that a lot of this is really technical oriented, the selling and the volatility, and we're not seeing the confirmation and other indicators that would suggest that we are this bearish. Another one of those signs, and again, I retweeted this one out from JC Peretz, very, very, very knowledgeable on technical analysis. The idea that we're not seeing a broad drop. In fact, RSP is the equal weighted S&P 500. Of course, the S&P 500 is a capitalization weighted. So the bigger names have the bigger weightings in SPY. There's our pullback. Whereas RSP is equal weighting. So everything has equal weight, the bigger names and the smaller names. So you can see a lot of this drop right here in SPY has been more in the bigger names and not so broad because of RSP really outperforming SPY going forward, off that level. So to kind of give you an idea of what that looks like on a long-term basis here, you can see that a lot of this move has been driven by bigger names. And now we're kind of getting a broad, and you can see how we pull back, when we come off this low point, we get a bounce in the equal, and then things start to take off, and the bigger names start to take off. We're getting that same kind of position here, this spike near a potential low point, similar to what we had right before the election there. So not surprising, from a sector rotation standpoint, utilities and real estate, which has been so beaten up, they're starting to rotate in the favor. Staples holding value better, still down, but holding value better than the broad market as a whole. In fact, Staples at one point was down about half of what the broad market was. Everything else really kind of pushing it down. Healthcare, industrials, materials, and energy, both lagging behind there with a little bit of a strength in the dollar. And of course, financials and technology, former momentum players, and there's your discretionary. All this coming down, very broad there, and a safe haven move there. So if I were now to say, okay, well, if you were to take a look at this volatility, the ups and the downs here, so really from this peak last Friday through, you can see, stocks are down 2.25%. A lot of this volatility, and then there's your staples, real estate, and utilities holding their value, because that's what they do in times of higher volatility. They hold their value better. So if you were to buy stocks at the worst possible time, at any of these peaks here, and you were to go through the ups and the downs, then you can see how even there from that peak, they're actually up. Those safe haven areas are actually up 1%, with the market down 2.5% over the course of those a couple of weeks here. So again, that's what these do. They go down a little bit. They go down when everything else goes down. They don't go down as much. And they bounce up. They don't bounce up as much. But in the end, they hold their value better and during these times of volatility. So don't worry about buying at the worst possible time in the markets, as long as you know what you're buying, and have some momentum trades, because you never know when that peak is going to be in the markets. But also start transitioning as we get higher and higher, more overvalued, into these areas that hold their value better in case of increased volatility. If we continue to be bearish, we've seen the sectors that are kind of matching and leading the way down. And so for our trade idea of the day, just to have this, and just in case, to give some balance to our active trading portfolio, especially since most of our passive portfolio is typically pretty darn bullish. You'll see here that this particular stock, Intuit, right, QuickBooks and TurboTax, you can see how it's been pulling down and breaking down with some pretty decent volume today. A little bit of a pullback. Now you notice when you look at some of these indicators like the market forecast, it's just now crossing below 50. Market sentiment line is falling, so path of least resistance to the downside. If you take a look at the Bollinger Bands, we're breaking below that lower band and starting to potentially push it down after failing at the moving average, trying to get bouncing off the lower band, failing at resistance at the moving average, and pulling back. And of course, from a long-term basis, it's got some room to go down the 160 or go and still stay above its 200-day moving average now that it's crossed below the 50. So there's some opportunity, earnings coming up on May 21st. So we can say, okay, well, I don't want to be too aggressively bearish here. And you can see May expiration happens to be right before that earnings. So what if instead of just straight up buying a put, like buying that 170 put here at the money, which costs $7.80, why don't we offset $5.10 of that $7.80 by selling the 165? That will cap my gains to the downside, but dramatically lowers the cost, which lowers risk, right? Because that's the risk. The cost of this option is its risk, its maximum risk. So we'll reduce its risk by capping its gains, and basically it gives me about a 1-to-1 reward to risk ratio. Trying to make 250. If it goes down to 165, if it goes up to 170, and then I lose 250. Now remember, if it goes up to 170, let's go back to the daily chart here. If it goes back up here, the 175 in that area, so there's your 170 mark. If it goes back up to that 175 here, and it does that within the next few days, I'm going to be losing $100. That's what this line, that's what the purple line tells me relative. And so as time passes, that purple line, as time passes, that purple line will start coming down towards the green line, but you can see not so fast. So we're a few weeks away, and if we get up to 175 and really breaks up, then I'll lose about half of what I potentially could lose. So we won't take the full maximum loss. We'll get out once it breaks back up above all these highs and kind of fails. And you can see here, if you look at the two-line version of this MACD and stochastics, where they're both falling and both below the moving averages, and then the lower halves of their chart. So you can see we've had this convergence, and now we expect a divergence on these lines to the downsides. If it fails that and gets back up above all this at 175, then we'll take our loss, small loss, and move on to another trade. So that wraps up a crazy day and a wild week on the market outlook videos here. Interesting to say the least, but nothing dramatically earth-shattering, right? A lot of these patterns are still there on the charts, and even you could almost even say today's move was expected if you were expecting that inverted head and shoulders to develop because of how the left shoulder was developed. This is kind of how the right shoulder would develop if it were to be symmetrical, and lo and behold, that's what happened today. Now, granted, of course, that doesn't, it was the news that pushed it, but the technical environment was there to open it up, because we've seen this before. So nothing that this kind of throws the technicals out the window, and certainly we don't see other confirming signs that we are that bearish. Now we know when we're going to be more bearish, right? We know what that support is. A lot of volume here in this area. So if we break this level here next week, we know how bad things can get, and we're prepared with it with our trade idea with an example using our trade idea of the day, but also expecting that we could bounce next week as well. Get back up above that, bounce off the 200-day, get back above the 50-day moving average. Wouldn't be the end of the volatility, but it certainly wouldn't be the end of the world either if we were to break that support. So thanks as always for watching. I hope you all have a great evening. Remember, the promotion has started today. So the more you post, whether it's new topics or replies to topics in the forums, the more likely you are to win one of our gift cards. So let's get posting there. Don't wait for me or Brandon to answer your replies. You can always answer anybody else's questions, reply to anybody else's topics, create your own topics. It doesn't matter. So engagement is what will win you those gift cards or give you the possibility of winning those gift cards. Have a great weekend, everybody. We'll see you all on Monday.